Okay, so Divergence. I know that a lot of you may have heard about Divergence. Maybe you've seen Divergence, you've tried to use Divergence. Maybe you do use Divergence in your trade. So we're going to talk about Divergence a bit today and maybe clarify and demystify some of it for you. Before we do that, if you don't know me or who I am, most of you do. I've been around the trading world for officially about 14 years. We've had our trade room open. I traded for about 7 years before that, very, very poorly. I was a remodeling contractor, just like you guys. I had another profession. I didn't come out of college as a financial whiz and go to work for one of the investment funds or any of that. I'm a working guy. I struggled tremendously for 7 years. I was the world's worst trader. Then something really big happened. And if you want to know more about that, we can talk more about that on Saturday. We're going to provide a little bit more free time on Saturday. I know you guys, this is the middle of a work day and we don't want to take up too much time, but on Saturday, it's a little bit more relaxed and I'll take all the time you need to answer questions. So I've been a professional full-time trader since 2008 and started the trade room in 2009. Quite bizarre to me, I became a trading educator when all I was ever trying to do when I was a struggling trader was to find the answer. I was always looking for an educator to help me. Never really found one. So I ended up figuring out myself, which is part of that something really big that happened. So since then, I've developed a trading system, and in order to trade that system, I've developed a series of indicators that we use for trading the system in our trade room. And then, of course, we provide those to our traders. And it's a one-time licensing fee. There's no monthly fee. There's no maintenance fees. There's nothing. Once you have our products, it's free upgrades forever. We don't nickel and dime you to death. We've also won a few awards along the way. Didn't even know we were being considered for them and found out somebody told us, hey, do you know you won some awards? Nobody told us. It's pretty funny. All right, so this is the standard disclosure statement. Don't trade with money that you can't afford to lose. Anything that you say that you see here or results that we show you here, you can't expect to achieve those results unless you do all the work involved. Trading is very risky. There's a good chance you're going to lose all your money and all that stuff. All right, so divergence. What is divergence? Let's make it really simple here. The definition of diverge is to move away from, right? So in trading, divergence is when prices of an asset, it can be any asset. So it can be any instrument, it can be an index, it can be any type of an asset that's tradable, as long as price moves. Okay. So in technical analysis, we make transaction decisions by identifying situations of divergence. Some of us do. A lot of us tried and gave up. Okay. If it's positive divergence or bullish, it occurs when the price of the instrument starts making a new low while the indicator starts to climb upward. Okay. So it would look like this. So notice the indicator. So we're using the relative strength index. Okay. So this is a momentum type of an indicator. And you'll notice that if you go from the high to the previous high, that it's actually on an upward trend. Same with price. Notice it goes from high to the previous high. It's on a downward trend. Okay. Now, conversely, the negative divergence or bearish happens when the price of the security makes a new high, but the indicator fails to do the same. Okay. So basically just the opposite. Now, in our trading, We really don't make a distinction between the two. We really don't care. All we care about is that price diverges from momentum. Okay. So when you have this upward momentum, you have increased buying momentum. That's obviously going to be having decreased selling momentum and vice versa. Okay. So momentum is figured out by the price changes over X bars. Okay. Now, there's lots of different momentum oscillators. Okay. There's some main ones that most people know and understand, like the relative strength index. Okay. And the formula for figuring out all of the points on that wavy line I showed you, the momentum oscillator. There's a pretty complex little algorithm to figure that out for the relative strength index. And then you have something that's very, very simple, like there is an indicator called the momentum indicator. This one's very simple to to figure out, and it's really just the closing price of the current bar minus the closing price of X bars ago. So for illustration's sake, because the math is really easy to see on this, I'm going to show you where this wavy line comes from. This oscillator, we see these, but we really don't know what's going on and how it's being measured. So I'm going to show you how it's being measured to help you understand how important divergence is and can be in your trading and why it's doing what it's doing. Okay. So we've got 2 points on this chart. So we've got the close of this bar. We'll call this the current bar. Let's say none of this has happened yet. So we have the close of the current bar, which is right here. Then we have the close of this bar 10 bars back. Okay. So let's say the value of this bar is 94.40 at the close of the bar. Value here, 94.33 at the close of the bar. So what we're going to do is we're going to take this 94.40, we're going to subtract the 94.73. That gives us a value of 0.07, okay, or 7. Now, that value is a plot on a graph, right? So you could plot that value, come straight down here, and plot that value on the oscillator, okay? So then we go to the next bar. We go to the close of the next bar minus the close of the bar 10 bars ago. Again, we're going to subtract 94.36 from 94.30 from 94.36. That's going to give us a value of 0.06. So we have another point on this wavy line that we all see for these oscillators that help us to determine momentum. Okay? Everybody with me? Staying with me? All right, let's move on down here because it does change a little bit. So again, close of this bar, close of this bar 10 bars back. We're going to subtract one for the other. We're going to get a 0.06. Now, going to get a little different here. So we've got the close of this bar and then the close of this bar. Now this bar closed lower than this bar. So what's happening there? We're going to end up with a negative number when we subtract one from the other, right? So now we have a negative point on the plot. It fell below the 0 line. So what has happened here is you can see if you glanced at this is an uptrend, right? It's an uptrend. But what has happened here is momentum has actually changed directions just momentarily. So we can keep doing this and we can keep plotting these points. And this is where your wavy line comes from when you look at an oscillator and you're trying to tell what's going on in the world, what's going on this instrument, why it's doing what it's doing. Okay. These are very, very important points for us to help us to determine divergence, right? So again, divergence occurs when there's a difference in the slope between the swing high of price or the swing low and the swing high of momentum, right? Now, typically, those are going to run together, okay? Typically, they're going to run, price and momentum will run together. They will be in lockstep with each other. So we're looking for something that is not typical. These are 7 of the most typical momentum oscillators that you may want to measure divergence from. So here's another illustration to help you understand how this happens. Okay. So this is a very oversimplified, let's just say these are bars on a chart. Okay. Very simple. But we're going to plot this curve saying that this is the low of each bar on the chart. Okay. Typically, the momentum, so this would be your momentum oscillator, it would generally look very much like the price. Okay. So everywhere along the line, they match. Okay. The curves match everywhere along the line that you look. Now, when price and momentum get out of sync, if you just looked at the curves, they look very much the same, right? So it's difficult for a lot of people to try to just eyeball price and eyeball the momentum oscillator and find the areas of divergence. Okay. Maybe in hindsight, it's easier to do. But while it's happening, it can be very difficult. So when price and momentum get out of sync, you'll see that in many, many points along this curve and along this curve and along this curve and along this curve, price and momentum are lockstep. They're moving in the same direction. But there are places where they change direction, where one is ahead of the other one. Okay? Where one starts to make the upward move before the other one does. That's very important. Okay? So again, quickly glancing at this chart and glancing at your momentum oscillator. You've got price is kind of drifting down and you've got this wavy line. So quickly, can you see the divergence quickly? I know some of you maybe can because you've been doing it for a long time, but by and large, most people will only see it in hindsight. Okay. So we have, yeah, I'm sure, like I said, some people can see it, but it's really easy to see in hindsight. It's much more difficult to hit it the instant it happens. Okay. And that's what's very important in our trading, knowing exactly when price and momentum have diverged. Okay. So right here we're setting lower lows. Everything's match. We're setting higher highs. Everything's matching up. But look here. We're setting a lower low on price, but a higher low on momentum. This is very important. When momentum turns before price, typically price is going to follow it. That's the secret of divergence. That's why you care. If momentum turns before price, price will typically follow momentum. Okay? So this would be right in here would be our expected move up. Okay? Because momentum is already moving up, but price is moving down. And there's the up where it goes to catch up. Okay? So if divergence is that powerful and it works that well, why don't we hear more about it? Why isn't it more widely used in everybody's trading? So it can be kind of confusing. Remember, I said in hindsight, divergence is way easy to find if you have the time to sit there and draw lines and find points and match them up and go, okay, I got divergence there, and okay, let's see. If I go back two swing lows, then I did have divergence there, so I got to go back two swing lows here. Yeah, that was down, that one's up. Kind of hard to find, right? So the problem is, while you're trading, it's confusing. You oftentimes don't know exactly where to look or what to look at. My problem, and I was actually explaining this to somebody last night, when I was trying to learn how to trade divergence, my problem was for every one that I found, I'd miss three or four that I would find in hindsight that was there the whole time, but I couldn't see it. So this whole divergence thing had to be easier in order to be useful to me, right? So this is where I decided to start creating indicators that I didn't need any oscillators. I didn't need any lines being drawn from swing lows to swing highs. I let the computer handle all of that. And then it tells me at what point do I have a divergent condition. And then it prints it on the open of the bar. Okay. I ended up having divergence here. I printed at the open of the bar. Okay. All of these, this is called the flash. This is our very first divergence indicator. And when we started using this, it changed things completely for us. All right. We also we have another indicator. It uses the same algorithm as the flash because the flash works so well. I thought, well, gosh, let's try the MACD and see how that works. So this is MACD divergence. This is our McDiver indicator. And again, we have divergence from price from the MACD. And every time you see one of these print on the open of the current bar, the open of this bar, this printed, you can see that price almost always tries to follow divergence. So this got real good to us and started working so well, and we started relying on divergence so much. Started thinking, all right, well, this whole thing about having an indicator pop up right in front of your eyes, not having to look away, not having to figure out and draw lines to figure out if you had divergence. What about the other momentum oscillators out there that people like to use? How can we use the same algorithm and then just combine them all together? So we took like 7 different momentum oscillators and we have it in an indicator now called Super D. So we use Super D to read 7 different momentum oscillators. And if we have divergence, that's a little late, Marshall. Yes. Thanks. Thank you for bringing that up. He did that because I asked them in the room this morning to please remind me to record because last event I forgot to record at the record button. I just so you know, Marshall, I've got 3 recorders going right now. How about that? So we have our super D indicator that has really changed things for us. I can't count on you guys. So what we're looking for now is we don't just trade divergence. We're looking for a combination of signals. And then the divergence is our trigger to get into a trade. Okay. So right here, our entry, our point of entry was right here on the open of this bar, or a little bit later if this bar dropped, we may want to try to get our order in down here. Okay. More on that on Saturday. Please join us on Saturday. Now, during chop, if you think about how divergence works, what I just showed you on that chart, when you think about it, if I'm measuring a bar and then I'm measuring 10 bars back when price is just kind of chopping around, it's just kind of drifting around, you'll get a lot of divergence, won't you? It's just there's no push behind the markets. There's nothing to to anticipate that there's some strength in the market so that we can anticipate weakness. Okay, so when you see choppy condition, it's very common to see an awful lot of divergence. So the point is that even though divergence is very powerful, you don't just trade it willy-nilly. You've got to have a confluence of conditions that tell you the time is right to take a trade. Okay. So this is what is very typical in our trade room. This is what we're looking at, and this is what we're going to talk about on Saturday. We have a confluence of conditions. Obviously, the one we've been talking about today is divergence. We're also measuring momentum. Why do you measure momentum? So we can anticipate exhaustion. If I'm measuring momentum, I'm measuring strength in a downtrend and weakness in an uptrend. That's what I'm looking for. Okay. So when we have that, we know that exhaustion is setting in. So you've got to be measuring momentum in order to anticipate when it's likely to happen. Then we're going to start measuring using volume. We're going to start looking at volume inside of every bar. We don't start doing it. We measure it inside of every bar, and not just any volume. I'll show you what we're looking for in a minute. We're looking for specific types of volume that gives us some indication that not only is price likely to be exhausted, it's likely that the sellers in this circumstance have been really strong coming into the bottom of this bar, but the buyers have been kind of sitting around here waiting at this price to start jumping in. Buyers and sellers start to uh, kind of compete a lot with each other. And I want to illustrate that a little bit here in a minute. So tape reading, we're looking at the speed of the tape and how fast the orders are being processed, um, and we're looking at relative order flow. Okay, now all of these things we're going to be having events like this to cover every one of these things. Right, so make sure you take down our the register, the one that you registered for this event, or the one that's up there now that says register -2. Save that and check it every so often, and you'll see a new event coming up. We'll also, of course, keep emailing you and let you know. And so here's that information again on Saturday at 11:30 a.m. Eastern time. We're going to do another event. It'll be a more descriptive event on our trade setups. Some very specifics on the rules, how we do it and how you can start doing it next week. All right. So again, we're looking for strong momentum. This is our meter indicator. It's got the bars turn black, and as momentum increases, the probability of a pullback or exhaustion increases. Okay, so as this color gets lighter, the probability of a pullback is becoming more inevitable. Okay, so we end up with exhaustion down here. Oftentimes you'll see a doji or something like that to anticipate that exhaustion is setting in. We also have a couple of other indicators that tell us when price is overbought or oversold. Remember how we had that the oscillator was plotting, right? So when that oscillator plots, you got to figure you have a 0 point, right? I showed you that zero line. Well, on the extremes, after like 70%, you're going to say, well, price is based on history. Price out at this far extreme is likely to be exhausted and want to pull back and stay between these lines. Okay. So instead of looking at an oscillator to determine when price is overbought or oversold, we just put it right where our eyeballs are, right there. Okay. Where all of our indicators are what we call our heads up display indicators. And they're right where our eyeballs are so that we can make quick and concise trade decisions. No, well, the line, it's on the line, so maybe it's overbought or maybe it's not. I don't know. Let's just say it is because I want to get into a trade. Okay. There's none of that. We have yes, no answers to trade setups. Let's talk about the thing that everybody likes to talk about, and that is the prevalence of the market manipulators. So they're out there. We all know they're out there. You see it every day. If you're sitting there watching your charts and you're waiting for your trade setup, and for no particular reason other than maybe a scheduled news event or something, but for no particular reason, whammo, price just takes off. Well, you got to sit there and wonder why, what caused that? Why would that happen? And could I cause something like that to happen? And you know, the answer to that is no. How about all the retail traders in the market at the time? Do we have the power to suddenly make price move that far, that fast? The answer is, of course not. So who did it? It's the manipulators, and they're looking to create a reaction, right? And a lot of times that reaction is panic and fear. So these guys are out doing their thing, taking our money every day. So if you're in a trade and it happens to you, what happens? You get scared and you make decisions based on emotions. If you're not in a trade and it takes off, what do? You get scared that you're gonna miss a trade and the whole world is gonna make a bunch of money and you're gonna be left out because you didn't know what to do. Right? So we start measuring and we start looking for where this is likely to be happening. We're going to talk a lot more about the speed tick and the ricochet on Saturday. And that's how we measure that what's going on there. All right. So we also have our pullback alert. Remember I said that we're going to be looking at volume inside of each bar. And when you have a particular kind of volume, you can anticipate exhaustion setting in. Okay. So this is two identical bars, right? We have the bar on the left where price opened, it dropped a little bit, then it just kind of headed north, pretty much most of the bar, and then closed up in here. Okay, nothing special. Then you have this bar. It opened, it dropped a little bit, then it came up and got up to the top of the bar, and then all of a sudden there's sellers up here. There weren't any over here, but there are some over here. So you get a lot of buying and selling pressure inside this bar. So if price has been going up for a period of time, especially if it's been going up in a strong way, and not just drifting up little bars, but we're looking at these big bars that suddenly shoot up. And it's been going on for a few bars. Profit takers are going to start jumping in, or those people that are in the trade are going to start scaling out. So you get a lot of this buying and selling pressure. The buyers are now getting exhausted. The sellers have come in, they're taking over. And you can see it in the volume. So another way to describe this or to think about this is, in order to confirm the exhaustion. Let's say this guy on the left, it's a tournament, and he's been fighting all night, and he's fought 3 fights tonight. And then this other guy, he's just been resting and waiting. Doesn't matter what this guy does. This guy's going to kick his butt because he's not exhausted. He's been sitting and waiting for his opportunity. And that's exactly how I think about it when we get our pullback alert. All right? Now, tape reading. So historically, I think most everybody knows about tape reading. And we do a lot of tape reading. And that's our speed tick indicator. So what we do is, rather than try to focus on a time and sales window and try to anticipate that something is about to happen based on what's going on in a time and sales window, we instead created an indicator that helps us to determine when price starts moving so fast that it's highly unlikely, not just price, but the orders are being processed so fast that it's highly unlikely that us little retail trader guys with our PCs sitting at our kitchen table are able to actually create a reaction like that. So we went and we started measuring the time and sales as if it was like a speedometer. And when price reached the orders being processed reached a certain rate, it pointed towards the only solution that we could come up with is that it has to be the big money people doing that. And then you go, okay, well, they did it. But then you got to say, why? Why would they do that? What are they trying to create? What is the point? They're not stop hunters. They're not trying to take our stops. They're not in this, to beat us up by taking our stops. That's too hard. This is way easier. Manipulate your emotions. Okay? Cause you to do something dumb. Okay? So we're going to measure the rate at which the ticks are coming in. And when we exceed a particular threshold, we know beyond a pretty good reasonable doubt that that bar has been manipulated for a particular reason. And we know that after that manipulation, it's very likely price is going to do something specific, like change directions, at least for the short term. Okay? Again, this was a big aha for us when we started measuring the rate at which orders are being processed. Okay? Now, as a byproduct, we have another indicator of when after we created the speed tick, We had another indicator that we noticed that even though maybe we didn't reach that threshold, but what we did have was sudden acceleration. That sudden acceleration in price or in orders being processed, sorry. Sudden acceleration in orders being processed. Maybe it didn't hit the threshold to generate a speed tick, but we did notice that if it was a lot faster than the previous bars of this histogram, that price would actually pull back. So we went back and we created this ricochet, and sure enough, more times than not, price is going to pull back. Remember what we're talking about here. We're talking about a confluence of events. I don't trade just divergence. I don't trade just momentum. I don't trade just exhaustion or volume or tape reading or relative order flow. I don't trade just one or two of those. I combine them all together. And when all of them are in agreement with each other, we have confluence. That's what triggers a trade for us. So the confluence, the important part of this confluence is it's all really non-correlated data. Non-correlated, meaning it comes from different places, different sources. Yet it all agrees with each other that something specific is going to happen. And when we have that confluence, we end up having confidence, which leads to consistency in our trading. Now, it doesn't happen every time, this confluence, because everybody knows the market's going to do what the market's going to do, right? It's 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 the way it's always been. But we can get as close as anybody to being right most of the time. So we have found an exploitable edge that we exploit every day, and divergence is a key part of it. So here's an example of what would be a trade setup previous to our most popular and famous indicator. So we've got 10 totally different indicators signaling a potential pullback. So we've got 10 things here telling us that it's likely price is going to stop and change direction. So what are those 10 things? So we have this momentum. So remember I told you this going from black to a lighter gray to white, almost white. That's strong momentum. And notice how price is moving straight up, hard. Okay. So you'll hear me refer to strong push a lot. This is a strong push, right? It's not channeling sideways. So there's one. Overbought condition. Pink outline. Remember the oscillator, the wavy oscillator? It's overbought. And so instead of having a wavy oscillator at the bottom taking up a third of our screen, we print it right on the bar. And this prints the instant that it becomes a condition. Right? As soon as the condition exists, it prints. So it's during the course of this bar. See more about that on Saturday. Our speed tick indicator indicates that the rate of orders being processed is way faster than we can do it. So it's likely it's a manipulated bar. Also, the ricochet indicator, the acceleration was really super fast. Our pullback alert indicator that's reading the volume inside the bar and the type of volume that tells us there's a churning activity. The flash indicator, which is the divergence, that's the lightning bolt in the back. We've got our McDiver, which is this diamond here. The velocity, which helps us to read exhaustion, but we don't do that one so much anymore. We've kind of this mometer has all but replace this velocity indicator. Then we have our major source of support and resistance right here, this line here. Okay. We also use minor support and resistance, which could be this high of the day. Okay. So we have a lot of confluence that said on the open of this bar, time to take a trade. And I tell you right now, if we see this in the trade room, nobody hesitates. There is no thought about it. We're all in. Now, because this has been so powerful, this whole setup right here, we ended up taking some of this confluence and creating our most popular indicator by far, and that's the rock star. Right inside the rock star, we have the Obos, the speed tick, and the super D, which includes the flash and McDiver and all the other oscillators. Okay. So now we'll have a strong push up like this. And then on the open of this bar, we get a rock star. And if the conditions are right, we have the confluences, then we'll short this. We'll take this trade right here. We do have rules. We have very specific rules. They are yes, no rules, right? They're a qualifying process. And if rule 1 is in place, rule 2 is in place, rule 3 is in place, now it's time to start getting ready for 4, 5, and 6 because we have a potential setup. Okay? Right there is where the magic happens. On the open of the bar, the gold rock star. Right? So if you see the link up there, you click on it to register for Saturday. Okay? Let me put that in there again in case some of you don't see it. Saturday, we're going to get into the nuts and bolts. All right. So you can go to that link and you can register for Saturday. And we're going to show you all the indicators in action. Okay. And how they print on the charts and where you make your trade decisions and how you know that you're going to have a good, that it's a good setup and how you know it's not a good setup. Okay. So, use that link to join. And while you're there, if you use that link to register, you can also, on the same page, if you scroll down a little bit, I think, you can sign up for a 5-day free trade room trial. If you've never done one before, you get a 5-day trial. Okay. And you can see what we do live in the trade room every day, 9 a.m. to 12 noon Eastern time. All right. So for this event, we're going to offer you guys 20% off all of our divergence indicators and also any one of our programs. Okay. And you can go to that link that's on in the chat. Let me put it in again just in case some of you can't see it. And use this Divergence 20 as the coupon code for your 20% discount. All right. Now, when you go to this, excuse me, when you go to this link, you'll see the different packages. If you go to the Pro Trader program, that's basically our one and done package. There's nothing else to buy except if you want to put the indicators on a second computer. There is an additional set of licenses for a second computer that's, dramatically discounted. But yeah, that's it on Divergence for today. We're going to cover a lot more tomorrow. It will hopefully be available within a couple of hours afterwards. I say hopefully. Last time we did this, the recorder didn't start, somebody didn't push the button, so it had to get redone, and it took a while. Today and Saturday, hopefully, you know, by mid afternoon. Any questions about divergence or anything else that we talked about here? We're only going to take a couple of minutes for questions today. I'd rather spend more time on it on Saturday when we will. It's a little bit more relaxed. See somebody typing. Pro Trader program also has for those of you that um, like to trade every morning. The You also get a lifetime trade room. You just come in anytime you want, as often as you want, no restrictions. The other packages, you're restricted to the extra income is a couple of months, and the starter program is a couple of weeks to kind of get up to speed on what we're doing and what the indicators do and things like that. But most of the traders that are in our trade room are part of the Pro Trader program. If the indicator is flat, uh, you know, technically no. Technically, if the indicator is flat, meaning that because you can have divergence, all it has to do is one be out of sync with each other. So if one is flat and one is moving up or down, that's still divergence. That doesn't tell us how big the move will be. That would be nice. But all it tells us is that they are divergent, they are moving in different directions, and that we can expect a change. And that price will probably try to catch up with momentum. Okay. All right. Well, thanks for coming, everybody. And I hope to see you all on Saturday. This will be posted up on YouTube later this afternoon. We will send out an email to those of you that attended here today and let you know what the link is. And feel free to send us any questions you got. Thank you. All right, everybody, have a great rest of your day. And hopefully we'll see you all Saturday.